Hi, this is Randy Finney with Right Side of the Chart, and this is a morning market update for Monday, November 5th, 2018. Let's go over the charts, take a look at, let's start out with what happened Friday, because that actually ties into where we're at today, and as far as where we may be headed from here. So I'll start out with some charts I posted on the site on rightsideofthechart.com Friday morning early. I took these screenshots around a little before 7 a.m. And what I highlighted is these were the golden downtrend lines, which we'd already broken out of. So that was the spark or the catalyst for this rally breakout above these downtrend lines here. But then I had posted on Friday morning, we had these bearish rising wedge patterns. Nice, clean, beautiful looking little wedge patterns, confirmed with negative divergence. And so I also had pointed out a significant resistance zone right here, just above that level, and that was comprised of a couple things. We had horizontal price resistance as well as Fibonacci cluster, a cluster of various key Fibonacci levels there. We call that a Fib cluster. Coming up on that, there's a 50% Fib, and and stated that the next sell signal would come on a break of those wedges. So we did. We went and punched up to those wedges. I'll get to the updated charts in a second. So that's ES right here. Again, that's how it looked Friday morning, and that's not the one I. Okay, this is the one I was looking for, and this is NQ. Same story again. This is Friday morning, a couple hours before the market opened, about 2.5 hours before the market opened, and there's that resistance zone. So I had us maybe going up to the top of that resistance zone again, Fibonacci cluster plus price resistance, and as of today, let's see what happens. So there it is. We punched up to the top of the resistance zone, went on to break down, confirming the sell signals with a break of the wedge, and so now what I'm seeing is quite the disparity so far this morning. I wanted to wait till the market opened. I pointed out on right side of the chart last night, there were these bear flag patterns on the 60-minute charts. You can see it here on NQ. So we had that initial impulsive leg down after we reversed off that resistance zone. And starting Friday and into last night. Now, I said the trading in the futures on Sunday nights, very light volume, and over the overnight Monday night early morning session. But so far today, we had an impulsive breakdown, and now that's usually, and it is on this alone, everything you want to see, because normally you would expect now, once you have a breakdown from a bear flag pattern, it's a continuation pattern after that period of consolidation. And what you look for is an impulsive breakout down below the flag, which is what we've had. And then you would take the flagpole, the distance leading down with the impulsive move leading down to the formation of the flag, add that to the top, and that would give your measured target. So from that point of view, check, check, check. However, what I'm noticing today is an unusual disparity, and it's not the first time I've seen this recently, but this is a live chart, and that was a live chart right there of NQ, and this is ES, the S&P 500 E-minis. They've gone in different directions since the market opened. Right now, as I'm doing this video, I'm showing a total of, let me click here, I had to click down on a chart. Only 3 of the 11 sectors in the S&P 500 are trading red right now. One's flat, that's basic materials. Again, as I'm doing this video, it's going to go back and forth. And the rest are some nice green gains, with financials up pretty big, energy up pretty big. Both of those up over 1%, about a 1% move in the REITs. And so what that's doing is you had a comparable flag in the S&P 500, and you'll know that if I'm trading the indexes, the two that I focus on, the two large cap indexes, are the S&P 500 and the Nasdaq 100. And to get a sell signal on any one of them where it's actionable, you want to see both break down. In other words, what I'm trying to say is, although that was textbook looking breakdown so far today, and it may prove to be play out of the Nasdaq 100 E-mini futures. And by the way, these show better, much better than on QQQ, and that's why I'm using the futures, because you have the round-the-clock trades. You can't really see these wedges as clear on the QQQ chart. But yet we don't have that, and this is the S&P, by the way. But we don't have any breakdowns here. You have the flag right there on the S&P. So one of two things is going to happen. Either that breakdown on the NQ will be foiled, buyers will start to step in because the rest of the market's moving up, or the S&P or ES will play catch up to the downside. And you can see here's a nice, that's actually, although that's an old fib line, there's some pretty decent support down there. So, the near term, all I'm trying to say is right now there's some mixed signals. You don't have confirmation yet with the ES. But if ES starts to roll over and breaks down below these flags, here, let's try to take a look at a close-up chart. Okay, here it is on the 15-minute chart of the NQ E-mini futures. So there's that same rising wedge that with Friday's highs and the breakdown, and there's the bear flag pattern. And pretty impulsive breakdown, everything you want to see so far. But when I look at ES, let's see, I might have to draw these out here. Yeah, I'll give you the lines. So far, we don't have confirmation there. So take it for what it's worth. When there's mixed signals, tend to stand aside. But this one can go either way. I just want to point that out. So let's watch for a breakdown here. The flag is getting a little bit long in the tooth. It'd be ideal to see this as a smaller flag pattern. But let's watch this and see if the S&P follows the QQQ's lead to the downside. You can see there's some pretty decent support if it does. And now let's jump out to the daily charts and take a look at what to keep an eye on. All right, so the big news on Friday, at least in my opinion, a couple things. We hit, as I pointed out then, the S&P 500 ran into the key 200-day moving average, and there was also some resistance there. So this is a daily chart we're looking at on SPY, and you can see right here, right about this level here, you can see quite a few candle reactions there, some reactions on those lows. There's the 200-day, and that's where we stopped cold. We had a lot of key stocks hit there as well. As I pointed out, we also had a bullish cross on the PPO, so maybe there'll be more upside. And then bigger news and what I've been watching too. And again, this is why you have some cross currents right now. You had these big gaps right here. This was a big gap last Wednesday the 31st. There was a gap up, and the bottom and tops of gaps are natural support and resistance levels. So we had there's roughly the gap. I hit it a little high there. So we've come in and we successfully tested the top of the gap in SPY and held it so far. The top of the gap should act and has as support, and if the gap gets entered by quite a bit, it'll probably be backfilled, and then the bottom of the gap is support. We can even see that better if we look at a 60-minute chart. So there it is. There's your gap right there. Let's drag a line. These are all just different support lines. So there's a gap, and it held. We had a little brief dip into it right there on Friday, but so far a successful test to the top of the gap, and that looks pretty good for SPY so far. You had a break out of the wedge here, the golden trend line, and it held gap support, and it looks to be moving up. But on the flip side, you had QQQ also break out of the wedge here. Let's see, let's give it to you. There's the golden trend line. We can look at it that way. And it has failed gap support. It's in the gap right now. You can see that it's already starting to move down. Not too far into the gap, but it may want to come in and back test the trend line. So that's my theme, is there's a disparity in the charts, an unusual disparity. And what it is, it's all about this. It's all about the unwinding of the FAANG trade, and that's FAAMG. Apple, this is the largest component of QQQ and SPY. It broke down last week. I had this 216-ish level, a very important support shelf. I talked about this last week. We had a brief breakdown before earnings, but it snapped back, and now it's clearly given up that support level. And I also had a downtrend line as well. I meant an uptrend line, but I removed that uptrend line. Either way, that support level has been filled. So Apple to me looks like when it's already come down this far, the 200-day moving average, exponential moving average there, as well as that 197.21 support level, and quite possibly this uptrend line, they look like magnets at this point. So I think we'll see more downside. And so here's my guess. Despite the cross currents now, I think Apple, from my experience, when you get so far away from a key level like the 200-day moving average on Apple, once you get far away, you're going to come back and test it, as it always has in the past, comes back for these tests of that level. And when you get that close, after being so far away, key support levels like that usually act as a magnet or like a black hole, and you get light gets close enough to a black hole or anything, it gets sucked in, and that's usually what's going to happen, or call it a magnet, if you will. So I think we'll see a little more downside in Apple. Could be a lot more. I mean, eventually, like I said, I think this 200-day, the long-term trend lines will go. So don't become complacent. And then one of the other big components of the NASDAQ 100 is Amazon, as well as the S&P 500. And as I pointed out, Amazon last week on Friday as well as Thursday came back, had, after their sharp initial leg down, came and back tested the 200-day exponential moving average from below. There was some price resistance there as well. I should put a line right there for you. And so far has failed. So that is bearish. Now it may just need to take a little breather, but so far you see the drop below that level, come back, we back tested and we failed. So the near term, well, let's just go with the overall longer term theme because sometimes these near term technicals, like I said, I can make a case right now to go long at the, on SPY, for example, or a lot of the stocks right now. But this market has been led up for years by those market leading FAANG stocks and the QQQ and the tech stocks. And what we're seeing, we continue to see what I believe to be the unwinding of one of the biggest bubbles in history. It's the FAANG bubble. Now, they're not overvalued by traditional metrics. It's just a crowded trade. Everybody is long those stocks, Amazon and Apple, and they're chock full of it. And as I already talked about, pension funds are getting killed. Balanced funds are getting killed because treasuries are not coming up. So what they're doing is it's the unwinding of that trade, of an overcrowded trade. And when you have a rush for the exits, everybody wants out. Even if they don't want to sell all their Apple and all their Amazon, they need to lighten up because they're overweighted. And I'm speaking generally about both institutional and individual investors. So we continue to see these stocks coming under pressure. And as long as you see that, it doesn't matter what the financials do because technology is by far the largest component of the S&P 500 and 21% weighting, whereas financials are doing great today so far, but they're almost half of that, about 13% weighting. All right, so to keep it very simple, there are some cross currents. There's still work to be done on the downside. We still could have, some of these gap levels hold, support levels, those recent bullish crossovers on the PPO and the daily chart play out. But the bigger picture is this. To me, it's more of a matter of has the counter trend bounce off the initial leg down already run its course, or is there a little more upside this week and possibly in the coming weeks? Maybe we come back and back test this trend line on QQQ. But just if you take a step back and you're not overly concerned with all the near-term rips and dips, if you're short this market and you think there's more downside coming in the fourth quarter by the end of the year, and it likely into next year, as I do, then I don't see any reason to second guess any long-term short positions, swing shorts, or you may want to look to short on bounces back to certain key levels. But right now there's QQQ on the weekly chart. That's a multi-year uptrend line broken, and every attempt so far to regain that key 40-week moving average has failed. We're still well below trend line support, well below the 40-week moving average on QQQ, and SPY doesn't look any better. There's our bull market uptrend line off the 2009 lows. We're well below it now. We had a couple weeks ago, we had a very impulsive red candle that put us on a long-term sell signal because of that. We're also well below that 200-day or 40-week moving average right there, although we're moving back up close to it. So again, to me, it's a matter of do we come up and test? We'll have a little more clarity today, I think, if SPY breaks down. And if SPY doesn't break down, what you might see is the buyers may come in and step in. We'll get another round of dip buying on Apple and Amazon, which are in large part dragging down the major indices. In fact, I can tell you right now, we have Apple down 3.18 as I talk. Microsoft, second largest component, is up about a quarter point. Amazon's down 2.63. Alphabet, both share class, well, class A is down 1.5. The other shares are down 1.64. So that's kind of what's going on right now with the SPY. Those are the top largest holdings there. And Berkshire is up real nice, a respectable 4.55%. Oh, interesting note. There's a headline came out over the weekend that Berkshire has now, I'll have to reference it, and you can do a quick Google search. Warren Buffett, or aka Berkshire, is buying back the largest. This is the largest or only share buyback since I think it was 2011, 2010. Huge buyback. And what it was, the point of the article was they're stating or implying they don't see any values. I don't know if you guys are familiar with Berkshire Hathaway. It's like considered like a mutual fund. Warren Buffett, it's a company of other companies. He has a lot of insurance companies, real estate, other things. And he basically buys companies and holds them in Berkshire Hathaway, or the Berkshire does. But so the point of the article was the fact that they're deploying, they have a lot of cash they're sitting on, and usually they use out cash for buying deals, and that is reflective of the fact they're not seeing any deals anytime soon. Hence, they're going to buy back their company stock. So you can, the overall spin on that, whether it may be bullish for Berkshire, and obviously as today Berkshire is up 4.53%, it speaks volumes to the market because Buffett has been one of the most astute stock pickers out there, as most people know, and therefore that's what he thinks. He doesn't see any, opportunities right now, and he's, standout opportunities, generally speaking. So, buy this company stock back. And again, this video is not to comment on Berkshire in particular, but there's that stock. Like everything else, it looks to me it probably is top. So you can see a long-term trend line off the 2016 lows, like everything else. And this is the thing, when you look at the top holdings of the NASDAQ 100 or S&P 500, you're going to see the charts because there's so much correlation because of all the indexing in recent years. It's been a massive trend to indexing. So you had a breakdown, back test, and we're still below. If it happens to eke out a new high, it will still be a divergent high. You can see strong negative divergences in place. And, this is one of the top components of the S&P 500. So to keep it very simple and end the video here, the near term and longer term outlook looks bearish. If you see the SPY roll over today in a lot of these sectors that are rallying, which I think you will, because these FAANG stocks are breaking, they're unwinding. These institutions, individuals continue to unload those companies. So it looks like the potential for that longer term, more downside that I'm talking about here, possibly from these levels right now in QQQ. I could easily see another, 8 to 10% downside, possibly more than that. And if it does happen, it will probably begin to snowball. This is a fast-moving market. If this bounce back to the 200 days and to backtest this trend line, I know this is a busy chart here on QQQ, but we'll use this one right here. So there's a uptrend line there that was back tested along with the 200-day moving average and a failure so far. Here's that gap. So let's come in and watch what happens when we backfill the bottom of Wednesday's gap. So that would be Tuesday's high right there from last week, about 166. If that gap support does not hold, that's not good. And this PPO bullish cross will fail. That will be a pretty bad sign when you have a crossover that quickly fails on the daily PPO. Same story with the SPY. If the SPY starts to move lower, which it will, if QQQ continues down, it will drag SPY down with it. You'll start to see panic selling in the other sectors and forced selling as well. And then you have the top of the Tuesday's gap around 268.33 or so. And those are, I don't want to call them the last ditch support levels, but if they break, then I think you'll start to see more of that WTF moment I'm talking about, our point of recognition where the bulls say, hey, everything looked good. We had these divergences on the RSI. Market was moving impulsively higher. Everything looked good. Looked like the correction was over. No. And then you get that second wave down, which I expect if it comes, again, the more we go down, the more it increases the odds that we're going to go down substantially lower. So I'm talking just push these markets down another 2% or so, and that could open the door for a waterfall type sell-off that we drop another, 8 to 10% plus from current levels. So there it is, and I'll do an update at the end of today if anything changes. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it, and as always, if you did, a thumbs up on the YouTube channel would be greatly appreciated. Thank you.